All right. Guilherme asks, since long-term VWAPs are developing, do you adjust the reference used on your prep during the session? If that change is substantial, let's say more than 10 handles in ES, if it's substantial, that is, or do you keep it static? The question is more about the weekly and monthly that are more sensitive to intraday movements. Great question. I absolutely evolve. I mean, they're dynamic references, so the prep is really, it's especially on the weekly and whatnot. Um, it evolves throughout the session, and so you need to stay evolving with it. So very good question. Um, don't just rely on what it was before the open. Stay up to date. Edward asks, for September 17th, why didn't you include the weekly developing value low as a bearish or even neutral reference point? This was a fresh test of the imbalance pullback down or imbalance down condition. Also, okay, so that's a secondary question. So let's see. Let's pull up the prep. So September 17th. So that's just yesterday. So yesterday, why didn't I use? All right, so I'm just pulling this up here. So we can have that viewing, or I'll keep an eye on it. Okay, so the question was, okay, we've just went imbalance down. Why are you not including the weekly developing value? So as he was saying, let's see, what price did you say? 33.60.75. Right, before the open. So it would have been, somewhere around in here. Anyway, so this reference, and it turned out it was a good reference to use, right? I was pretty bullish off the potential imbalance pullback and whatnot on the yearly, where we'd seen that overnight rejection from. And so I made the choice that I kept the CVA structure, which is in the same vicinity. Okay, so the CVA was up at 51 or so, and so let's see, this level here. So essentially, one thing that I try and do with my prep is, as much as possible, I try and keep it clutter free. I try and keep it from grouping a bunch of, it's one thing if they're very precise, then you can just group them and it looks like, a lot of times, in fact, I'll delete things and just make it one reference because I want it to, again, be simple. So I'm interested in the 3350s, Edward, for the weekly level as well as the structural level. And so I just made the choice to kind of simplify and keep one line in that area to use. So it's not that I didn't, use the weekly at all, because like you said, it is a fresh condition, shift to getting imbalanced and whatnot. I was leaning bullish, obviously, that provides some dissonance. That's a roadblock there. And I'm not sure what I said in my prep, but yeah, another option to get on board with the long is a hold above 3350 for a great trade location there. So that's what I was looking at. If I were to get that breakout pullback of that composite structure, then that would be going rotational and whatnot for the week, and the week unable to maintain that imbalance down. So just because there wasn't like an extra reference line in the area doesn't mean we weren't necessarily using it. And your second question here, also, can you explain your thought process in ES the last couple of days where the yearly development value high, monthly prior value low, bullish condition was rated as more important than the more recent, I think that's a key word he's using, quarterly developing value area high going rotational and being bearish from that area, plus a fresh bearish September 14th, which I believe was that recent 2-day composite value breakdown. September 14th, huh? So anyways, it was 15th for me, but same thing. So, he's saying we've broken down from that area, and the quarterly over here is rotational, and so that's bearish, and I've maintained that that's a bearish level. I did think today, and I think I noted this in my daily market insight, that if we were to come up there again, kind of knocking on the door of breaching it, kind of similar to how I feel about if we keep knocking on the door of the quarterly VWAP and yearly developing value, right? And that's why I think why we ran a lot of stops through there today, and I should say was able to push through there today, is because we continue to press on that. I think if we continue to get back up to 34.20, it's probably not going to stand. It's at least going to do something like we saw today, where it tries and runs stops through those areas. But in general, I mean, the higher time frame is more important. We're getting a yearly imbalance pullback set up, and not to mention, I know that you can cite the bearishness on the quarterly, but I could cite bullishness on, the immediate weekly and whatnot coming in today. That was a major additional bull reference there as that market went rotational. And so, you want to fade those lower extremes as long as that condition holds, which ultimately it fell apart today. So yeah, I was leaning more on the yearly because it's more important in my eyes than the quarterly. And, I'm leaving open the room, the potential that is, and let's pull over my actual kind of prep chart. Right, so here it is. And I'm leaving very much open the potential by kind of, it doesn't matter that I'm focusing on this bull zone, right, which is this, versus this bear zone, which is this. That's 110 handles. So, I'm leaving open the potential for some of this, right? And a stop run below here. And to me, it looks like Monday we might come in here and be really bullish again. Overall, the breakouts mostly failing, right? It didn't. In fact, we never got a push down since Futures Friday, right? We had this attempted break, and then it pushes higher, and then it really just holds and then pushes, and then it really starts to kind of work back into this bull zone here. So that might be a wick of yearly, imbalance pullback there. But anyways, yeah, this is bearish. I get it. And what's the likely destination for that move? It's down here. But what's a major freaking roadblock? The yearly being imbalanced here. And so I'm going to use all those time frames together, Edward. And if the yearly is going to break down, I will participate in the remainder of the quarterly move across to its destination. Otherwise, we could bounce around in here, and I'll be getting short from up here. I'll be getting long from here. I can use it all. I can kind of have my cake and eat it too in that regard. All right. Hope that helps, man. Feel free to follow up in the chat if anything about that wasn't sufficient or not clear to you, or the thought process behind what I just explained wasn't clear. You just let me know. Okay. Patrick asking, hey, Merritt, struggled mightily with long-term VWAPs, specifically developing a bias, then trading against it. Also, when I completed my DMIs and took a look at yours, so you did compare, and that created major amount of dissonance for me. Need help. What can I do? Well, I'll tell you this, man. Long-term VWAPs are the most difficult thing to get the quickest. It really is that way. Um, back in the day, even when I used to mentor students by hand, as in like I didn't, well, essentially what we're doing like this, but even in a small group setting or one-on-one, teaching someone the NADRO methodology one-on-one. I've done that with, I forget how many people, half dozen. And I would get questions, a month and a half down the road, and it would blow my mind that they didn't understand what I thought may have been a basic tenet of long-term VWAPs, right? So, and some of those same students who were the slowest to kind of get those light bulb moments and really have things click with long-term VWAPs ended up being some of the best in terms of ultimately using and reading narrative using long-term VWAPs. So I get it. It's a lot to take in. It was especially difficult, but this is a intensive course. And don't, like, this goes for not only Patrick, but all the rest of you. If you feel like he does, and it's a lot and you're not getting the same prep as me, and why would you? I mean, I don't think you should expect that. But I do think that you can do your prep, and I do think you can compare it with mine, and I do think you can learn something new each and every day. And I do think you could continue to go through that process over the next several months and start to put it together. So that's really important, that you just kind of embrace that learning process. Also, if I was teaching you, Patrick, one-on-one, I would have never said, here's the yearly, here's the quarterly, here's the monthly, here's the weekly, go use them all tomorrow. We're only doing that because this is a action-packed, super intensive, short course, essentially. We are cramming it in here. It is a feat of strength every week for me to get the lessons distilled and packed into what I need to tell you guys. So one thing that you might do is take more of the long-term learning approach, which I might recommend or use if I was teaching you by hand. And that would be, start with just the composites and add just the weekly to that, right? So create your narrative from the combination of CVAs and weekly. And then once you get really comfortable with that, use CVAs, the weekly and the monthly. That is, in fact, I kind of feel embarrassed almost that I'm having to explain it after someone asked me a question about it, because quite frankly, I think that would be my most commonly, like most standard recommended path for you guys to really buckle down and learn these, if you find it challenging, if you find it you're lost and things like that. Because quite frankly, the conditions we've been in here with the S&P, where we're talking about the yearly, it's major. We're talking about the quarterly, it's a major deal. That's actually quite rare, right? That only happens half dozen times a year, especially in the yearly. You guys just happen to have hit a week where it's like all coming together, and it's a very, very important inflection on some of these higher time frames. And that's creating these kind of larger gyrations and people talking about these 100 lots, 200 lots, 500 lots going off in the S&P. And that's why that's happening, because this is a major inflection. Think about it. What hedge fund manager, what long-term portfolio manager doesn't care right now if they use the tools that we use, if the S&P holds here or not? Because guess what, guys? If it doesn't, we're gonna go way lower. We're gonna begin to react again with VWAP and prior value, and we're talking about 315, 320 points. That's huge. So it's a huge deal right now. But could you have come in and just used the weekly? Yeah. It doesn't mean that all your trades are winners. No, it doesn't, right? So yeah, man, you could start slower. You could just add one at a time and really get comfortable reading narrative with those. And then, maybe at the end of the day, as a review process, you could pull them all up and just kind of take a look and whatnot. But then the next day, I'd recommend that you don't allow that view to influence you and you stick with that. I think for most intraday traders, you could easily get rid of the yearly and the quarterly and almost never miss them. Think about it. If I'm going to take this yearly imbalance pullback, ultimately, what trade am I going to get, guys? Well, it's either going to be some type of extreme fade once it goes rotational here, like I would have done earlier today and whatnot. Right now, I'm not going to try and take that trade, So we'll see it setting up, maybe Monday or something if that happens. And so ultimately, do I need the yearly? Yeah, it helps me, and sometimes I take a swing trade and things like that. But it lets me know that any type of rotational extreme fade I might get long now on the weekly or the monthly or something. Monthly's been sloppy, unfortunately, right? Above and below. But any extreme fade that I might get in those markets once it's confirmed rotational, then I have this extra info that the yearly says, hey, this is a great trade location on the higher time frame. And so those trades are especially good, right? I might hold for bigger targets. I might have more conviction in the trade and be able to hold. Who knows, right? You might. So at the end of the day, you could get rid of them and, you still take an extreme fade if you get it, as long as your structural stuff makes sense and whatnot. So you don't have to have all the time frames. You don't have to have them. Do they add some value? You bet you. But do you have to have them to be a master CPT? Not even close. Don't have to have them. And that's part of stuff we talk about with people who are ready to talk about it in advanced group mentoring. We talk about you developing your niche, the charts and the analysis that you like to do best, and where and how you like to operate and what tools you want to use. Some people are very heavy on the scalping side and they really like the order flow stuff, which we haven't gotten to yet. Some people, have a day job and they want to swing trade and they really lean on the yearly and the quarterly much more so. Anyway, so like I said, I'll wrap it up here with this question from Patrick. One, you can't expect to be nailing. Like, I would be very upset if you were as good as doing the pre-market prep as I am during your first week after you learn these tools. I'd be pretty pissed off, okay? Because it took me a long time to be able to get good at it. So I expect it to take a long time for you to get good at it too. Not as long as me, because you have a helping hand here and some kind of best practices, but it's still going to take time. So embrace that and just relax with that. Get a little better every day with it. Make it a part of what we're going to talk about soon, which is review process and things like that. We're going to really want to teach you guys how to self-coach and how to, as much as I can, prep and review and all those things, which are critical to getting better. And then the other one, you could start adding them one at a time. All right. Rafi or Rafi. I'm sorry. I know we did that before. I can't remember. Okay. Imagine we are rotational inside the weekly developing value and have recently been rotating upwards to form a potential extreme fade short opportunity on the test of weekly developing value area high. Okay, so let's just, got no blank space anywhere. Problem solved. So we've got our weekly, and we've been rotating around, and here's a potential extreme fade. However, on the intraday chart, we're clearly accepting above the weekly developing value area high level. Should we be bullish against the reference or bearish because we're still accepted beneath it on the weekly chart based on the weekly rhythm? Oh man, I'm very impressed with this question. I kind of hate that you asked it because it's very difficult to answer. But that just shows how smart you are, that you're thinking about these things. So, I hope everyone understands the question. So this is the weekly, and then here is, let's say we're going to take the weekly same level, and now we're going to go to an intraday chart, and the intraday chart is going to look like this, right? Clearly above it, multiple rotations holding above it. And this is the same level, but on a different price scale. Okay, if that makes sense. In fact, no, we're fine. The question is, let's look at rhythm on the weekly, right? It is very obvious that it's this. I don't know, we'll give it a lower one here, and then this. Okay, so just above it, because it's above there, we haven't accepted above there. Rotational, we're an upper extreme. But the rhythm on the intraday chart, I want to draw it differently. It's here, and the rhythm's like this. And then we already got that, right? And now we're kind of like here, maybe here. And he's saying, well, which do I believe? Which do I go with? Am I bearish because the weekly is accepted still, rotational? Or we have clear rhythm acceptance on our intraday chart above that reference? The answer is you can at various times use either. And I hate to say it. Now, you could develop a process where you only do one, but you need to keep it's going to depend on other factors and other charts here if you want to know how I do it, okay? How I do it is, if this was a yearly imbalance pullback, okay, from the yearly developing value high, we're really bullish this market. And so what do you think I might do in this situation? I might get really aggressive and start using the intraday to get long as we just begin to breach the weekly, even though the technical condition on the weekly is still rotational because of that longer term, the rhythm and acceptance picture on the weekly. Intraday, we've got a line in the sand and it broke and we're holding above it. So I'm going to hold all these truths in my head at the same time. I know the weekly is technically still bearish, but I know that intraday we're starting to hold above it. And because of the other factors, in this case being we're really bullish because of the other charts, like say it's a yearly imbalance pullback, right? I'm going to be more aggressive intraday at hopping on board. So what I don't want that to become for you guys is this like anything goes. I'm kind of at a place where I can do a bit more advanced things. I can be looser with some things and get away with some things. And if you guys are looking for clarity at this early stage in the game, that's pretty difficult when you could say, well, it could be one or the other. So is it all just worthless? Does it even mean anything if it could be one or the other? And I would say that it needs to come down to your prep for the day. What do you see going on in that market? Remember, that's how I just handled this. I said, well, I'm really bullish. So guess what? I'm going to be a little more aggressive. I know the weekly doesn't necessarily confirm yet on that chart, but I'm going to go ahead and get involved. If that starts breaking down, right? Well, guess what? Well, now I know, like, okay, that aggressive sequence of maybe attempting to get long in that area, that's over. that's over. We have to stand aside on that because the weekly is confirming, hey, we're staying rotational. It's not going to get imbalanced at this point. So I was getting involved using some short-term tools, knowing that the weekly was in a potential condition shift. And once I see that that's not looking good, then that I'm done with that aggressiveness, looking kind of operating in the space between when a market is technically rotational but might be getting imbalanced. What I used to teach was just use intraday. Don't worry about rhythm on higher time frames and all that kind of stuff. Get your lines in the sand and then just use intraday rhythm to be your one time frame simple acceptance picture, and then just trade it. Just go with it. And that's going to get you involved in places where it does and does not work and whatever. But yeah, you know, it would, in this narrative that I came up with here, I'm not looking for weekly extreme fade kind of shorts because I'm bullish because of the weekly and maybe the quarterly or whatever, right? Maybe this is a multi-day CVA we're breaking out of, but the weekly just doesn't say we're imbalanced yet. I don't care. I've got 3 or 4 other things that say this is a place to be getting long, and guess what? Intraday is telling me that too, so I'm going to do it. We're almost always going to have something along these lines, guys, where one of the time frames says, well, this is not the right time yet. We don't wait for all time frames to wait to say it's the right time. We wait for some clarity somewhere and hopefully some confluence among a couple of them, whether that's price confluence or directional confluence, right? And then the intraday needs to make sense. We don't just do stuff, you know, stupidly without the intraday giving it to us. All right, hope that helps. Let me know if you need any follow-up or whatever there. Tony, sometimes long-term VWAP plus or minus 2 is a good extreme to expect some reversal. I'd say quite a lot of the time because sometimes we can see price pushing very hard without any retrace. How can we determine what type of condition is suitable for this reversal? Why were you bullish on? Okay, so that's a different question. The only time it's not really acceptable is when we're really in a clearly established imbalance, Tony. If we're clearly, you know, imbalanced up, this is the +2, and we're like settling into this kind of deal, like, you know, and it depends on. Wait a second, you're asking about long-term VWAPs. My bad. Long-term VWAPs are different than intraday. So I don't know of any situation. Well, I could give you caution on one, but in general, anytime you see markets pushing extremes on multiple time frames, then it's going to be tough for that market. I'm not saying it never happens. Crazy things happen, but in normal conditions, it's going to be tough for that market to continue sustaining that directional move. So the one time where you, I think, are more likely, this is important, to potentially see a move that just keeps going versus using an actual extreme is, let's say it's the weekly and it was rotational, okay? And then all of a sudden we get something like this. And here's the +2. This, and especially if there's other bullish factors on this market, on other time frames, this market's saying, hey, we're going imbalanced up. When it's brand new imbalance, I'm less likely to fade those extremes because by definition, value is migrating. So what's the +2 telling us right now? What's not as valuable because it's going to be doing this, right? And so it can really kind of ramp against it and then settle into more of a normal rhythm. And at that point in time, the +2, once it settles into kind of a rhythm on that time frame, the +2 becomes usable again. But during that transition phase, the first time it really starts to tell you we're imbalanced and now we're pushing extremes, and other time frames are also, in this case, bullish, not the time to say, well, it's an extreme, so I'm just going to look to short. That's my bias. Nope. Not when it's a fresh kind of condition shift to imbalance. All right, number 2, why were you bullish on ES before today? Is it because the yearly development value high or the rejections on the quarterly VWAP, or is it something to do with ES characteristic? It's both of those. It's a confluent area. Price, it's mainly about the yearly holding imbalance. But guess what else is at that same exact level? Quarterly VWAP. So, it's just some extra confluence. Guess what else is there, right? Monthly prior value low. So it's a nicely confluent spot. And the yearly, to me, this is rare for me, but the yearly is really driving the show in my mind. It's very important. Rafi with another question. Secondly, do you keep all 4 long-term VWAPs visible at all times during the session, or just ones that are relevant to your narratives? Would be great to see the way you lay out all your charts across the screens. You are looking at my current chart book I've been using. This is new for me. This is very condensed. Used to, I would have yearly, quarterly, monthly, weekly, and a footprint chart on this monitor. And then on another monitor, I would have, I'll draw it here. I would have regular TPO, composite TPO, and then a split between RTH and ETH. And then execution stuff on another window and whatnot. Right now, you're looking at everything I'm looking at for the S&P and for crude. But the answer, yes, I always keep up all the long-term VWAPs so that I can monitor and see what's unfolding. Diedrich, how does increase in volatility affect how you create your hypos, lines, zones, that type stuff? Well, the good thing about the long-term VWAPs is that they adapt pretty quickly. And in fact, a lot of times when you have an increase in volatility where things might be getting blown out on the CVA chart, blown out on maybe even the weekly or something, those are areas that typically make sense that you're seeing big moves because there's key shifts in condition occurring on the quarterly, the yearly, that type deal. So a lot of times it's these things make a lot of sense. Like think about it. We're approaching that yearly high or, yearly +2 or whatever. And I'm saying, hey, I'm putting the tweet out, hey, this could be a medium term top. Do you think that pickup in volatility surprised me whatsoever? No, it didn't. It wasn't surprising. So that's something that's really, really amazing about not only the all forms of our narrative analysis here with structural stuff and long-term VWAPs. We know a lot of times where the pickups in volatility will occur before they occur. We don't know if they're going to occur or not, but we know where they're likely to occur if certain thing, if then scenario plays out. But specifically with adjusting things, I mean, you guys witnessed this firsthand, a 3-day CVA, which may have originally looked like this. What does it look like all of a sudden when volatility goes crazy? You witnessed this. It looks like this, right? You've got like individual levels, and the intraday rotations are as big as the CVAs themselves. So they become more like small single zones instead of, oh, I could take a return pullback all the way across it, and it's like an upper end and a lower end. No, it becomes like one zone that you trade from. So that's the big difference. Other than that, almost every single tool, and including the composite structures, when they catch up and you start getting new composites, all of our tools adjust to volatility. From the intraday developing value to the long-term VWAPs, everything is essentially volatility derived in its size and nature. And so that's pretty cool. Things shift and adapt pretty quickly with these tools. Steve asks, I struggle with good confluence at VWAP multiple times this week. Felt like I was breaking a rule. Does good confluence generally rank higher than poor DVA trade location, specifically around VWAP? Perfect example today with ES at 1017, right? This is the return pullback of the CVA structure. You know, after the morning kind of crack and whatnot. Granted, for me, I was still bullish at that time, but hey, you know, if you were totally focused on the return pullback of the CVA, great. That would be, we have one exception. I tried to hide this from you guys for a while just to make you focus elsewhere, but I'll tell you, the one exception to not doing an extreme fade or an imbalanced pullback of DVA is when you have a level that is perfectly confluent. You have one of your hypo based, you know, levels, key line in the sand or whatever, that's very important to you, not just yesterday's high or something, right? An actual really good reference where there's a narrative behind it, and hopefully confluence like you're talking about. Then yes, you can trade when that lines up and the VWAP provides that trade location. And I'll say, especially in the S&P, it has more pullbacks to VWAP under normal circumstances than a lot of other markets. Greg, I'm liking gold's 75 to 125 tick rotations. Gold seems to trade 24 hours with volume only moderately higher than RTH beginning with the London Open. Which to use, RTH TPO or full 24-hour? Market seems to honor RTH CVA sometimes in the full 24-hour session other times. Why is that? That's because they're both representations of the truth. If we just, you know, we could duplicate all these tools we're using across even more time frames and say, well, I need to look at this profile and this profile so I have the full view or whatever. At some point, we've got to start cutting tools. We've got to start, because I mean, this is a lot. Right? What I present you guys with is a lot of things. And even what I present to you, some of you may thin some of that out, right? So there is no right answer to what is the perfect profile to use for a market like gold. You know, I'm fine with the US RTH session, whatever, I forget what it is. It's, what is it? 720 central to 230. Exactly. Yeah, 820 to 130. Exactly. I think that's a perfectly good session to use. Hey, if there's a bunch of volume from, you know, the London Open, then fine, use it. It's going to be real data. It's not like you're inserting something that's fake, right? There is no magic bullet to any of this. They're just simply good tools to use. You make the best judgment calls you can about timeframes and things like that. So yeah, trust me, you're going to use a 24-hour profile and the RTH would have been better. You're going to use an RTH and the 24 would have been better at different times, right? This is just what we're dealing with the randomness and the complexity of multiple timeframes of markets. We can't be this omnipotent like trader, right? We have to narrow down our vision to have some clarity. Otherwise, we're always looking at what could have been or should have been, or getting too complex and overloaded with information. No, it was a great question, Greg. Absolutely. Stefan, Areas, not lines. Do you have an objective guideline as to how wide of a level? I've done this a couple times. I'll try to do it again here. I don't have a. If anyone else remembers my answer to this, feel free to do it to let everyone know. But I'm going to try and replicate what I've done on some Futures Foundation Futures Friday sessions. So, two different CVAs, right? This could be anything. It could be, instead of two different CVAs, imagine this is weekly developing value extending here, and this is yearly developing value. Which one of these is going to get a bigger area in terms of areas, not lines? The bigger one. The bigger one, yeah, the lower one here. And so that should tell you my logic, right? Now, specifically, I don't know. I eyeball it for sure, but I would give this a level around it, like this, something like that. And this, I'm going to do something similar. So what is this? This is about this big, right? So if we take that and we say, okay, 1, 2, 3, 4, 5, so 6, 18%. I don't know. 18% of the width. I'm looking at that area, but I've never gotten that quantitative about it. But like, if we draw it again and try and do something else and say, okay, like, this is the area. Well, guess what? That's too wide, right? 40, 50% is too much. 20% is probably fine. Ultimately, another thing that comes into play here is what? Is rhythm on the time frame in which you're trying to determine the acceptance. So it's an area based on, let's call it 18%, 20% of the full width of the reference. And I don't know if that's always going to hold up, guys. I'm just like spitballing here for you to try and somehow show you what I see. The rhythm's also going to, matter, because if the rhythm is wider, you're going to need to see more of a movement through, versus if it's a smaller rhythm, you might need to see less. But you would still need to hold both those things in your head at the same time. Areas, not lines, and the rhythm picture to kind of ultimately make your decisions. Can you talk about how you link your charts with levels? Yeah, it's super simple. So these 4 charts here, this is chart number 2. See the number 2? This is chart number 9, 15, and 16. So 2, 9, 15, and 16. So if you look at my prep chart, advanced settings 2, you'll see I have 2, 9, 15, and 16 to copy the chart drawings from. That's all. Jao asks, hey Merritt, talking about swing trades, do you use the weekly or even intraday to pull the trigger in your swing trade entries in the yearly, or no? When it comes to the swing trades, you just look at the yearly, maybe the quarterly. All my personal swing trades start out as intraday trades. So I don't, when you think of a swing trade, you think, okay, higher time frame, wider stop, like all that kind of stuff. Not for me. I'm not saying it's always going to be that way, but right now, the way I approach any swing trades and have over the past few years is it's a normal intraday setup in which I end up leaving the core position on for past the past the exchange reset, right? So it starts out as any regular trade that we may have talked about. Oh, that the huge risk reward, huge. Um, how long does the advanced group mentoring program run? It is a 3-month program. If y'all have any questions about that, check out the website. Email us at info@apterostrading.com. Gabriel asked, you're not using the volume chart anymore? I tried the 3-minute yesterday and I find it more clear. I'm using it all. Right now I've got, these set to 3 minutes, but throughout the session, I'm using multiple charts. I'll look at my 3-minute chart on like my prep chart, and I'll change this one to a volume chart. I'll kind of dance around right now, which is different from me. Used to, I had no time charts up whatsoever, and I just always used 3,500, 5,000, something like that for ES, and typically 1,000 for crude. And lately, for some reason, I just have been dancing around and trying different views and doing different things. That's just part of the evolution, and always experimenting and trying to see things as good as you can. Is there a chance, Sean asks, is there a chance to miss return pullbacks or breakout pullbacks using a 3,000 volume chart versus a 1,000 volume chart or a 3-minute chart? I mean, yeah, what's the downside to a time-based chart, especially, is when volume picks up, you're way more likely to be left in the dust. Your 1,000, if this is the level, your 1,000, your 3,000, and your 3-minute volume. 1,000, 1,000 is going to look like this. Let's say it comes into the level. It puts in a little thing like this, maybe does this, and then does this. 3,000 might look like this, pretty just like normal. And the 3-minute might look like this, right? That happened in 3 minutes, that entire bar, because the volume picked up, the speed of things picked up. That's one of the downsides to using those time-based charts. They can be quote unquote slow when the speed of the tape picks up and things start flying around. Whenever I'm trying to dial stuff in and things are really fast and whatnot, I'm typically going to have a volume chart up of some sort. So don't think that I'm only using 3-minute charts these days, because I'm not. I'm just using them quite a bit more than I ever have. So yeah, there's a chance to miss it. I mean, if it just runs. So David asks, hey Merritt, I see the monthly on crude has hit its destination at a monthly development value high. At what point does the destination become a bearish setup? If we expect to remain balanced, would you prefer a wick above it and fail, or do you wait for a return pullback setup? So here's what he's talking about. Here's the monthly in crude. So as you can see, we've been narrating this is what's cool about doing a live type class like this. Hey, are we going to stay in balance down? Are we going to stay in balance down? Oh, interesting. This is looking like really weak, like they can't push it, and ultimately it's not staying in balance down. That definitely changed here. It didn't give an extreme fade of the lower end, and we reached the destination. So when we reach that destination, that is not a place where I'm just saying, okay, it's bearish, let's short. Now, again, if there was a bunch of other time frames that said this is where you want to short, this is where you want to short, well then yeah, I'll make an exception and I'll use that likely destination getting hit on this time frame as a way to also get short, as a confluence type read. But this as a standalone chart here, just looking at one chart and not considering anything else, absolutely, that's a great great call the way you phrased it. It's a likely destination. I'm not really looking to, for shorts. If it does, as you said, give a pattern, which it kind of did here, right? It stalled here. It put in a wick and then sold, and then you get a test right there, which was, I guess, high of day today, right? That is acceptable in terms of using that as a way to be bearish and get short a market and on this, again, standalone time frame. So that's really the answer. If there's a level that's a destination, if we get to it, that's not a trade. But the more we try and get through it, and then the more we fail, then absolutely, I'm interested in trading from it then. So it's really all about giving some type of a failure, that type thing. And guess what, guys? We have a thing called a faux trade. You may have heard of it. Stands for first opposite extreme. And that's what this is. It's the first opposite extreme of a developing value area following a failed imbalance on the other side. So we were imbalanced. That all failed here. This is the first test of the opposite extreme. And so think of the word foe like an enemy. It's not a great trade. So that's something I've taught students in the past. Watch out for faux trades. Doesn't mean you never ever do it, but under normal situations where that's not the best trade location ever on multiple time frames, then heads up on faux trades. And the same applies to intraday DVA. We could say, hey, this is intraday. Forget that it's weekly, right? First time after you fail on trying to stay in balance down and it goes up, that first test of the other extreme, that's probably not where you want to stick your neck out. Let it give you a little pattern, let it set up a little better, and it's a much safer, higher win percent play. Unless that's the best trade location you've ever seen in your life on multiple time frames, then short the heck out of it, right? Giovanni asks, creating CVAs is some art and some science. So if I can pick your brain, would you consider splitting today's ES session around the 33.18 mark and merge the top part with yesterday's to create a new CVA? So, just glancing at this before we even dive into it, I can see that there was some rotational behavior here, and that there's a low usage, only F and G period, and then there is a rotational period here, right? And what does that tell us? It's pretty cool. Why did that low usage area occur right here? Because it's the point of the breakout pull. You know what I mean? It's an important point. That was the moment of the big breakdown from that. He's asking about 33.18, right here. So really, this market was balanced here, right? In a sense, not really, but there was more balance here. We zip through. That's why you only have a low usage area there. And then we put in more time and more volume there. So we have more of a distribution here. That's what he's talking about. And that is one representation of the truth of what happened today. I don't see much balance today at all, though. Okay. So when I look at this profile, you see how it got to this level, this thickness, like this is what I call a long, toothy profile. But look at how changing the view makes it look different. See how all of a sudden you see, oh, look, two distributions, but having it like more standard view, it de-emphasized those distributions, but we could see them. But really, there's not much balance at all. This market almost, and I hate to even use this term, but essentially it was like one time framing down, and then we hit this level here and we bounced and we kind of one time framed up. There's not a lot of balance there, so I'm not overly concerned about splitting it. Look, if you want to split G period or something, And, if you want to do that, I mean, it's going to work nicely. It's not a problem. But is it going to change anything about our analysis? Looks like we might cut the CVA and slightly lower the composite value high. Um, and we already know that this 3310 to 3320 area was a massive breakdown on multiple time frames. So, it doesn't add anything for us. It doesn't do anything. Am I going to lean very heavily on this value area from 94 to 13 quarter? No, I'm not. There's not enough balance there. It's a, an afternoon bounce. It's not really balanced. So, um, anyways, yeah, there's nothing wrong with doing it, but what is it doing for you? That's a lot of times when people start to get a little too granular with the splits and stuff. It's like, what's the point? What's the benefit? What's it doing for you? So I prefer the more. Um, I prefer splitting when there was real balance and when there's essentially like a single print between two areas of real type balance. That's kind of my rule of thumb. But like I said, no problem if you want to do that. It is legitimate. All right, guys. That's all the questions for today. Great questions. I know you're drinking from a fire hose. I know this week has been tough, but man, what I'm seeing from you guys in the room is very impressive. Don't feel bad if almost like Patrick's question around feeling lost, not being able to really put it together quite yet. These things take time. It's a ton of ranking and distilling. One of the things we work on in advanced group mentoring is, ask some of the guys that in our class that started in August, ranking and distilling, ranking these different references, distilling things down to what's most important and what you want to use and what you want to not. That's a skill each of you can be working on. So this coming Monday, we are going to talk about more of the work around trading. So it's almost like a little bit of a breather week, which is great because we're trying to put a lot of things together here last week and into this week. So it'll be very good for us to have a session where we're going to talk more about the work and the business of trading and things you need to be doing in terms of routines and review work and all that stuff. So we're not going to be throwing a bunch of new stuff at you in terms of charting and trading come Monday. So I think that's going to be, it's the perfect time for that right now as people are really trying to put this stuff together. So we're going to continue, nothing new analytics wise, charting, trading wise next week, but we are going to talk about very important things around outside of trading hours or journaling during trading and stuff like that. All right. Have a great weekend, everybody. And we will talk to you Monday.